Hi there. Welcome to Morning Markets. I'm Lindsay Biscaya. Here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. There are multiple reports Iran may be nearing a potential agreement with the U.S. to end the conflict. Both sides are working towards a short, one-page memorandum, with negotiations appearing to be gaining momentum. Officials expect a response from Iran on key issues within the next couple of days. Loblaw's first quarter results came in slightly ahead of expectations, supported by steady performance across its grocery and pharmacy businesses. The company is maintaining its outlook for the year and continues to expect solid earnings growth as it invests in store improvements and operations. And shares of Advanced Micro Devices are soaring today. First quarter results for the chipmaker beat expectations. The company issued a stronger than expected outlook driven by surging demand for artificial intelligence chips. Revenue and profit both climbed significantly from a year ago, with AMD's data center business emerging as the key growth engine. And we're keeping an eye on the TSX this morning, now above 34,000 points to start the morning, up 1.4%. Similar situation in the U.S. We're seeing a lot of green today. Stocks are rallying on solid corporate earnings. Also, that news of maybe a potential end coming to the war in the Middle East. You can see S&P 500, Dow Jones, and the Nasdaq now all well above a full percentage point. And as we're watching, the S&P is at all-time highs today on optimism that the U.S. and Iran are nearing a peace deal. Bloomberg is reporting that Iran is evaluating a new proposal from the U.S. that would include a gradual reopening of the Strait of Hormuz and a lifting of the American blockade on Iranian ports. So let's get more now from Kelsey Keane, Director of Equity Capital Markets at National Bank of Canada. She joins us in studio. It's always great to have you.
Thank you for having me.
What do you make of what we're seeing today with the markets? It seems like quite a rebound. Is that something to get excited about, or just more of the volatility?
Yeah, we're certainly seeing a real risk on in the markets, and that's been going on for the last couple of days, and then more on the back of the announcements on a potential peace deal with Iran. And a lot of this optimism is being led by the technology sector, specifically in the U.S.
Yes, so led by the technology sector. That's what I wanted to get into, renewed optimism for AI. Do you think tech stocks are kind of adequately pricing geopolitical risks for the conflict in right now?
We have been seeing the stock markets kind of react in swings over the last, few months now at this point that we've been going through this conflict. I think what we have been seeing to validate where some of these valuations are is we have been seeing some strong earnings. So that is also adding to the optimism. And it's not fully just on the back of some good news out of the U.S. president.
Strong earnings. A lot of these earnings, though, I was talking about this earlier, too, is before the conflict in Iran really started up, right? We're not really seeing the results of that yet. So do you think in the next quarter, the tech stocks and some of the big companies that have posted such solid results will continue to do so?
I think certainly the market is expecting that. So what we're seeing is large fund flows into all the AI thematic ETFs. So there's a lot of optimism around the sector. And one of the very fascinating things about this whole thematic is that we don't know how big this potential growth is. So I think we're seeing a lot of things even beyond just the technology stocks. So we're seeing people rally behind this, and there's money flowing into infrastructure, the power, real estate, and all of that to build out the connectivity around the data centers to actually provide the power for these AI companies.
And you agree with that, right? Like, these are some of the sectors you like: energy and infrastructure, commodities, real estate related to AI build out. So tell me more about some of those sectors that you like, and then we'll get into what you want to stay away from right now.
Yeah, absolutely. So even if we look back in Canada, who's going to benefit from this? So Canada is full of very energy rich equity companies or equity listed companies. So anything that is related to feeding the power demand. We know how much energy it's going to take to power these data centers. Think about the infrastructure. A lot of these data centers still need to be built out. So we're seeing announcements. We're seeing some IPOs being listed in the US. We're seeing more build out of that in Canada. We're hearing announcements, will there be data centers in Calgary and how that build out looks like? And then there's also a real estate play. So these data centers have to go on undeveloped land, but they have to be connected to a power grid. So there's a lot of companies, public companies specifically, who can benefit from these tailwinds.
Okay, so let's get into some of the sectors that you're maybe staying away from right now, given the volatility.
So I think specifically on the AI thematic, one of the sectors that's most disrupted is these software as a service businesses, because what we're seeing is people are acknowledging that this is a service that can be done more efficiently by an AI model. So those companies are struggling a bit. You could argue that maybe the valuations right now are a bit overdone, and there's still some value with the data there. But those are the sectors I would say just to, they're going to struggle a bit.
And when it comes to software companies, you say that there are some that might be okay if they have valuable data. Can you elaborate on what you mean by that? Because we are in a phase where it's like some might become redundant and some might survive through this.
Yeah, I think it's more so the ones that have valuable customer data. So that will ultimately be valuable. Will that, I think with that, what we have seen, especially in a public market context, is you see consolidation with those type of companies, historically when we've seen them in other industries.
What does customer data mean? Can you is that, I'm not sure if that's not a great question, but what do you mean by that?
So I mean anything, if we think about, consumer society, what can companies sell to? So is there, proprietary data that would help companies learn more about their customers.
Trends and stuff like that.
Exactly.
Okay.
Yeah.
Canadian employment data, that's coming out this Friday. What are you watching for there?
So I think what we have been seeing is that hiring in Canada and the US has been slow to pick up. I think there's been a lot of uncertainty. Therefore, companies are holding back on making big investment decisions, specifically when it comes to labor. So I think we have to see if, unemployment remains stable and if there is growth going forward, and then what the knock-on effects are for central bank policy on the back of that.
Is a lot of that also waiting for these CUSMA renegotiations to pick up in the summer? Is that part of the reason that we're seeing kind of slow growth in this area?
Yes, definitely CUSMA is adding to the uncertainty right now. So I think that there's, what's the outlook on business growth? And then also how do these trade negotiations impact specific businesses, specifically in the auto sector?
Right. Okay. All right. We'll leave it there. Kelsey Keane, appreciate you coming in studio as always. Thank you.
Thank you so much.
And Kelsey is the Director of Equity Capital Markets at National Bank of Canada. We're going to take a quick break right now. When we come back, we'll get the latest on Honda suspending its Canadian EV project. That's next. Welcome back. It's time now to take a look at today's market movers, and we're joined by Bloomberg Equities reporter Avalon Purnell to break down some of the big movers. It's great to have you, Avalon. So we're going to start with AMD. A lot of talk about advanced micro devices this week. It hit a record high today. What's behind that move?
Yes, as you mentioned, AMD is up more than 15% after the company gave an upbeat second quarter forecast as it continues to cash in on the AI spending craze that we're seeing across the markets. It also reported a first quarter beat that hit practically across the board. And after the print, AMD got several price target boosts across the street and an upgrade to buy at Goldman Sachs, who said that AMD should be an outsized beneficiary of enterprise agentic AI adoption.
Interesting. You're also watching Disney. So what drove Disney's second quarter beat, first of all?
Absolutely. Disney is up about 7.2% right now after reporting second quarter results that beat expectations as guests continue to spend more at resorts and on cruises, and also amid improving profitability at Disney+. Also worth mentioning that it had strong demand at the box office as well for movies like Zootopia 2, Hoppers, and also the new Avatar film doing really well as well.
Did Disney management, though, mention any impact on performance from macro pressures like higher gas prices, for example?
Yes, the CFO did basically shake off those concerns, saying that higher gas prices were not necessarily having an impact on parks as of right now in this earnings call this morning. That being said, they did notice that there was a little bit of softness in international visitor traffic to the U.S. parks.
Interesting. Okay, you're also watching CVS. Why is CVS stronger today?
Yeah, CVS is currently up about 7.7%. That's after the health insurer boosted its full year adjusted EPS guidance as Aetna profits increased. It also reported adjusted profit and comparable sales for the first quarter that topped estimates. RBC writing in a great note that the report came well ahead of expectations amid notable improvement in CVS's healthcare benefit segment. Also worth noting that this is just another great step for U.S. health insurers in general, who have had pretty good print for the first quarter this year.
Okay, Bloomberg's Avalon Purnell joining us live. Avalon, appreciate it. Thanks so much for your time.
Thank you.
We are hearing reports that Honda Motor is freezing its Canada EV project amid a strategy overhaul. And we got more from CTV's Rachel Aiello on that.
Largely based off of reporting from a Japanese news outlet indicating that Honda plans to entirely suspend its plans to build that $15 billion EV plant in Ontario. Now, this comes after Honda had previously indicated they were going to halt their plans to develop for 2 years, citing market insecurity and stability. So CTV News has reached out to both Canada's industry minister and Honda on this. And what I can tell you, Roger, Honda telling us, quote, has nothing to report at this time. So not confirming, but not denying this reporting. And then similarly along those lines, Industry Minister Melanie Joly did not deny this reporting, telling us essentially, you know, the industry is facing significant change and challenges because of the U.S. tariffs on the sector, and said the Canadian government will continue to support, quote, existing automotive facilities. So read between those lines any way you'd like to, Roger. Canada's finance minister also had this file in the industry file previous to his current job, telling Your Morning today that Canada doesn't have any money directly invested in this plan, but had promised production and building supports for this development, which now seems to be essentially off the table. And I think the big context here is the uncertainty around U.S. tariffs. We had the Japanese ambassador tell our colleague Vashi Kapelos not that long ago that access to the U.S. market was going to be key for any increased Japanese investment in Canadian auto sector. So an indication here that the lingering tariffs from the U.S. is hindering the ability for the Ontario auto sector specifically to develop and get the kind of investment that it's needing.
All right. Something else going on today with the PM going to make an announcement about a different Canadian sector. Any idea what's unfolding there?
Yeah, so we do have some sense. So it might be a less good news day for the Ontario auto sector, maybe a pretty good news day for the Quebec aeronautics sector. So the Prime Minister has an announcement later today, this afternoon in Montreal. What his office says is an announcement of a new investment in the Canadian aerospace industry. And now what Reuters is reporting this morning is that that's going to be Airbus announcing that AirAsia is going to be ordering 150 of its A220 jets, which are produced in Mirabel, Quebec. So if that is the case, the Prime Minister will be there to announce this boost for the aerospace sector, but will likely also, Roger, face some questions about the bad news for the Canadian auto sector in Ontario with this Honda plant.
All right. And do we know how long that deal is going to last? Like, is it over a decade or longer?
Still waiting to get some more details on that, but I think at this point it's fair to say any new investment in whatever Canadian sector is going to be embraced and championed by the federal government. Obviously good news for that sector if it is the case. While I think some increasing pressure for the government, we heard this from the Prime Minister this morning indicating there is still a need to get a deal with the United States that works for Canada, because the longer this trade uncertainty persists, it's bad news for the economy across the board.
That was CTV's Rachel Aiello. Up next, Suncor is sliding today despite a jump in first quarter revenue and earnings. We'll break down those numbers right after this. Stay with us. Oil producer Suncor posted higher first quarter earnings and revenues Tuesday after the market closed. The company reported record first quarter upstream production and refining throughput, but cut its refinery utilization forecast. The stock is sliding today. It's down almost 6% at the moment. For more on their results now, let's bring in David Traynor, founder and CEO of New Constructs. It's great to have you join us. Thanks so much.
Thanks for having me.
What were some of the standout points in the first quarter earnings report that you saw?
Look, I think Suncor remains a very profitable business. It's growing. It's got great utilization, great operational efficiency. It's a national treasure for Canada to have a company that's able to productively utilize its rich natural resources, and I think this is something people should be happy about. Look, the stock is dropping just because oil prices are dropping, and it's just in sympathy with that. Otherwise, a very strong quarter and a very strong business.
Okay, so I was going to ask you, why do you think the stock's down almost 6%? But you don't think that has anything to do with the earnings report and more so because of oil prices?
It's almost entirely. Look, all oil-related companies and stocks are going to drop when you see a big drop in oil prices, regardless of what happens. The earnings report wasn't a blowout report. I mean, they beat expectations soundly, but look, the outlook was not as positive as it could have been. But in my opinion, that's really inconsequential when you look at the valuation of the stock and the real cash flows implied by the current stock price. It's still very cheap. And the growth and the profitability that we're seeing today is more than enough to justify the current stock price, which is why our target is significantly higher, closer to $85. And we think that's really a no-brainer given the cash flow strength in this business.
And we heard management in the earnings call today say March's average WTI price being 50% higher than it was in January. So obviously they're aware of these swings and the volatility that we've seen when it comes to oil prices as well. If we see this continue, though, how do you think this would impact the earnings for Suncor for the rest of the year?
Yeah, look, I think prices are likely to go down from here. I think the issues with the Strait of Hormuz and Iran will be mostly resolved probably in the next few weeks, if not in the next few months. But I think, look, Suncor has a cost advantage with its oil sands capabilities, and it has a lower cost point, lower price point for profitability. And so this is going to remain a very, very profitable business. I don't think the markets have gotten overly exuberant around its existing profits because we know that that's going to be pushed higher based on what's happening with WTI crude. But long term, it's an excellent business, very well positioned. And again, I think a treasure for Canada and its ability to productively monetize these resources is something that the country should support as much as possible.
And Suncor also reported record upstream production, refining throughput for the first quarter. But are Canadian companies still mostly selling to the U.S. and at a discount? What's the capacity at this point to find new buyers, say, in Europe or in Asia?
I think that the demand outlook, the global demand outlook for fossil fuels and for energy in general is so strong. It really doesn't matter who your clients are. They're going to be there for a while, and it's not going away anytime soon. So I think, look, Suncor is, as long as it's selling to places that are going to continue to have high demand, I'm not so worried about who the end customer is. I don't think there's a diversification issue here. I don't think there's any chance that the demand for energy in the United States is going down anytime soon. So I think they're safe to have the U.S. as a great customer.
It is interesting, though. The CEO did say today that Suncor began producing jet fuel at a Montreal refinery in December. And he says it was intended for domestic market, but has instead been selling that fuel overseas amid a tight market. What do you make of that? Because I thought for most companies, the issue, if they did want to sell overseas, and I take your point that you don't really care who the customer is, but the issue was infrastructure, not being able to get product to market.
I think the infrastructure is getting much better. Obviously, Strait of Hormuz throws a huge wrench into that. But I think, look, that the ships are better, the ports are better, and clearly, when you've got the supplies, you have the supply constraints we have recently with jet fuel. They're finding a way to sell it. I mean, smart move. Hats off to Suncor for anticipating and being in a position to profit from the extreme shortages in jet fuel and the price advantages they can get from that. So, hats off. And then just another great example of how this business is one of the most profitable energy companies in our portfolio. It's one of our top recommendations. We think it's a core holding. Great returns on capital, great margins. And it's because they got smart management. doing things like, hey, there's a major supply shortage for jet fuel. Let's sell jet fuel because that's going to boost profits. I mean, those are the kinds of things you want to see management be able to do swiftly and efficiently, and they've done it. And the business overall, with its margins, returns on capital, reflects long-term intelligent capital allocation, and that's why we think this should be a core holding for any energy portfolio.
If oil prices fall, which I know you think they will, most do, will higher production and refining those still make sense for companies like Suncor?
I think when you've got utilization rates as high as what Suncor is, it's sort of not a big deal if they're going to go marginally lower from here. I mean, you want there to be the ability to make hay when the sun shines, and they've got that. If they need to back off a little bit, not a big deal either. I think the fact that they're sort of vertically integrated allows them to be smart about how much they produce and versus how much they sell, and have great real-time feedback so that they don't have supply overages or demand gluts and things like that that are going to long-term produce profit issues. And I think that's why we've seen such steady margins, profits, returns on capital, because they're able to manage the full vertical stack there. And that's, again, another advantage for a great business.
And I think you touched on this a bit, but how much CapEx is involved in adding capacity to raise output? Like, are they able to lower costs to compensate for any extra expenditures?
I think the question you're asking is, does it hurt margins when capacity is lower? And yeah, it's not. You always want to have 100% capacity utilization. That's the goal, because that's where you can maximize scale. But you don't see with these kinds of refiners huge impacts on margins when they do operate at lower utilization. It's not going to crush their business. They're designed to be able to handle that kind of thing. It's not ideal, but the margins with Suncor can more than handle the lower prices. I mean, they're just going to go back to more normal prices, right? And this has been a profitable business before the Strait of Hormuz, and it will continue to be a very profitable business after the Strait of Hormuz issues are resolved.
Okay, we will leave it there. David Traynor, founder and CEO of New Constructs, really appreciate your time today. Thanks so much for joining us.
My pleasure. Thank you.
When we come back, who are the biggest winners from the Iran-Hormuz supply shock? We'll find out after this. There are multiple reports Iran may be nearing a potential agreement with the U.S. to end the conflict. Both sides are working toward a short one-page memorandum, with negotiations appearing to gain momentum. Officials expect a response from Iran on key issues within the next couple of days, though neither the White House nor the State Department has publicly confirmed the details. And Cenovus Energy is bumping up its dividend by 10% after delivering a quarter driven by higher production and elevated oil prices. The company's strongest ever quarterly production cycle saw a significant jump in profit, in part because of stronger margins in its oil sands operations and its recent acquisition of MEG Energy. Suncor Energy's first quarter profit, meanwhile, missed estimates. However, the company did post quarterly sales of more than $10 billion, which beat estimates. Suncor achieved record Q1 upstream production of over 875,000 barrels per day. The Calgary-based company also said it had record refining throughput and refined product sales during that period. And the TSX is seeing some gains today. We're keeping a close eye on that, just below the 34,000 point threshold at this point. It's up still 1.2% today. Similar story for U.S. markets. It seems as though some solid earnings are helping to boost markets up, as well as a potential end to the war in Iran that has investors feeling a little more confident. All three of the main indexes up more than 1 percentage point at the moment. Well, markets opened sharply higher today, as you just saw, as a negotiated end to the Middle East war is reportedly within reach. Meanwhile, Canadian investors have a slew of earnings to look over, including Cenovus. We sat down with Jim Thorne, chief market strategist at Wellington Altus Private Wealth, who says the energy giant is one of the biggest winners from the Iran-Hormuz shock.
We want to become a resource superpower, or a hard power, and I think Mr. Carney understands that. And so you've got some energy stocks that have really benefited. I mean, that are up, between 70 and 80% for the year. And what does the world look like if we go from $100 oil down to $60 oil? Doesn't mean that these companies are bad or their cash flow is bad. It's just that the sentiment might change. So, you might sit there and see a period of time of consolidations. But long term, if we take advantage of this situation that history has given us, Canada is looking really good going forward.
The big question is, two things. Can we? And has the world changed enough? Has this been closed long enough that people are now looking and saying, let's find an alternative?
Yes, I think it has. And I think, where I get everybody upset, because what I do is I sit there and I go, President Trump is pragmatic. And I don't listen to the noise. Yeah. And I also, when I go out west, I sit there and I go, Mark Carney's pragmatic. He's a pragmatist. He's not an ideologue. And when you listen to Mark Carney in his economic areas, he understands this, and he's got to slowly move Canada back to the center. And so we're in this period of time where things have changed. Energy and resource security is top of the list, and climate, even though it's important, is moved back down. So yes, it's very important to Canada. And the real question is going to be for us is, how quickly do we want to move to basically grab this generational opportunity for us?
And what's it going to take, or what's it going to need? Is it going to mean government spending or just government approval?
Well, I think
the green light from the government.
Right. Everybody lost it with the spring statement, right? And I think, what Carney knows is that, look, the global capital markets have had enough with us. Mm-hmm. And Carney also knows that we've got to evolve quickly. And so I think he's going to use debt to help do that. And so I think it's going to be a transitional phase where he does use debt. And listen, debt to increase the productivity of an economy is good. He understands that. Okay. And then we change the environment so that, foreign capital comes in. Remember, we had the Shell deal with ARC. And so, it's early days, but the problem is up here in Canada is we can't move as fast as the United States. So when I hear the Prime Minister say the risk is the United States, I interpret it completely differently. To me, it's Trump and the Americans are moving. Mm-hmm. And, we take the world as it is, not as we want it to be. We have to adjust rapidly. And when we do, the future looks bright for our economy.
All right, hopefully, and we have to keep up. And the reality is the Americans are next door to us. They're not going anywhere.
No, they're not going anywhere.
And we're still going to be dealing with them.
Yes, sir.
All right, let's talk about some stocks you want to look at. Synovus, what were you liking about it, or what?
It's just energy. Canada Energy. After a pullback, I think we're going to get a pullback here. Then the will we expand capacity? People understand our natural resources are saved. Can we get past, or can we be honest with ourselves in that the oil in Alberta relative to Venezuela and relative to Iraq is better for the environment? Can we shelve the carbon capture? We're starting to hear things. You're starting to hear about approval of pipelines to the United States. That's our short-term solution. You may not like it in terms of our economic sovereignty, but that's all we got. It's going to take 5 years for us to basically get ourselves together. So energy is going to be a key component of our industrial strategy. A little bit of a pullback here because we ran in, but investors have to use this pullback to position themselves, and Synovus fits right in there.
And okay, we've got a few, so I want to get to some. TransAlta, essentially.
It's a pipeline, but it's going through a generational change, right? So if you like turnaround plays, new CEO, it's fine, but it's lagging the space. I'd put it that way.
You put it that way, but can it catch up?
Sure. Yeah, but it's going to take time. But, in days where we've got like Flextronics up 27% pre-market and AMD, the fever's coming back, right? So this is going to be about, as building portfolios, is going to be tactically adjusting your portfolio. And I think, 8,000 is my target, but we're going to have these rolling bull markets. And right now it's memory and hardware in the United States, and it's gone vertical. Just like gold did a couple of months ago, it'll reach a level and then we'll trade sideways.
All right, and you mentioned gold. I am gold. People going to turn their attention back to gold now, do you think?
Yes, but the thing I like about it, but the difference is we've had our generational trade. So the five baggers off the table. Yeah. My view for gold between now and the end of the decade is 10,000. That's a double. The S&P is going to double. So think about this. Gold and silver are beta plays. I love them. I love them. But the big money's been made. And as this fever starts to kick in, everybody's going to be looking at, where's the next Flextronics, or where's the next Micron, or IM Gold had a great run. It's a great company. Same thing with Pan American Silver, right? Fantastic. But you've got to change your perspective and to realize that now the big run's over, and now they've got to execute. Mining is a very difficult business. But yeah, I still like to spend. I've been an advocate all the way along, having 10% of your portfolio in gold and silver. Yes. But I haven't changed, right? I haven't changed. But yeah, but as a portfolio manager, it's about rotating capital. We're going to be in this running bull market. So, how much dead money that's going to be consolidating do you want in your portfolio? That's the question every individual investor has to ask.
And what are you doing with how much dead money do you have?
I'm trying to get everybody. So for me, when the war started, it was sell gold, sell energy, rotate capital. I think tech is the place to be for now. Hardware over software, when we build out an AI platform, that's where we are. But, then you sit there, we've thrown the baby out with the bathwater with software. I really like that. Passing of the Clarity Act in the United States, you've got to look at crypto. I love banks because we're going to, as oil comes down, interest rates are going to come down. And the big question is, when is Tiff Macklin and Jay Powell realizing that they're too tight and they have to cut more? And when they do, then the consumer kicks in and real estate kicks in.
That was Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Coming up, we will check in on the markets and get some ideas for your portfolio. Stay with us. It's been a challenging several months for investors trying to navigate volatile markets during the Iran conflict. Let's find out how one portfolio manager has been positioning and some stocks he's added to his portfolio. We spoke with Shiraz Ahmed, CEO of Sartorial Wealth.
Seems to be an outlier event happening every single day here and there. So it's definitely been one that we've been watching very closely, and it's never a dull moment.
And how have you been managing? What are you looking for? What trends are you looking for? Are there any trends with what's going on right now?
So in our practice, we're primarily momentum-based investment managers. So we look at momentum in the sense of risk-adjusted return, which is really kind of the primary way that we look at momentum. And so we're constantly rebalancing the portfolio to, the best way to describe it, it breathes with the market. So as we saw over the last little bit, the markets breathe towards a higher concern over geopolitical risk and energy and higher levels of volatility. So the risk on, risk off, it's constantly rebalancing. So that's kind of the way that we've been doing it over the last little bit.
Have you been busy?
Yes. To put it very lightly, it's been very busy.
So where is the rebreathing taken you?
So lately, it's taken us to a little bit of a higher weighting in energy than we have historically over the last little bit. So one of the first stocks that I kind of wanted to talk a little bit about was Marathon Petroleum. As one of the largest oil refineries in the United States, they are one that has, frankly, done extremely well as a result of the current geopolitical crisis and the current conflict that we're in right now. They've also increased their crack spreads a little bit as well. I'm by no means an energy analyst, but that being said, they are really well positioned, and there's a degree of insulation in there. They've done a recent $5 billion share buyback announcement as well. So I think that there's a lot of legs still left in this trade. And again, it's risk-adjusted return. So given what we've seen over the last little bit, the stock has actually performed quite well.
And does it feel like that trend is going to continue? If even what we're hearing today, that maybe there's settlements, there's a deal in the Middle East. I mean, they've been pumping out like crazy, haven't they?
They absolutely have. So this has been a phenomenal time for any energy producer. But as a refiner, so they're basically taking crude oil and making it into gasoline and diesel and other uses that we actually need as consumers. So they have a degree of insulation in their actual operations as well. So because they're a refiner and not necessarily one of the drillers, it's a different play. So that's part of the reason why we like it. And again, they have some momentum in there as well.
Okay. Going the other way, are there any things that you're staying away from, like with this momentum and with the way things are heading? Are things you're shying away from, sectors you're shying away?
I wouldn't necessarily say that we're shying away. So again, as part of the way that we invest is we try to not necessarily make the human emotional decisions when it comes to investing. So a lot of it is very algorithmically based. So we have representation from a majority of the different sectors that are out there. Currently, I'm seeing that there's less of a focus on software in general. I think with the current AI trend that's happening in the background, we've seen them just unfortunately in the penalty box for a little bit as we still kind of sort out what the obvious winners and losers will end up being. So we've had a lower weighting in software, and frankly, I think there's little to none at the moment.
So no indications. It's the trend is downward still with that.
So far, and again, if the momentum starts to pick back up in them, again, we're happy to participate. So we take a very agnostic approach. These are all widgets. They're tools in a toolbox. So we'll jump in, we'll jump out. If we see that there's value, we'll happily jump in.
All right. When you're seeing values in Roche Holdings, a global healthcare leader?
Yeah, so they're a very diversified healthcare company where they have both the diagnostics and the pharma side of things. They're a nice dividend play as well. We don't necessarily invest for the dividend, but it's one that has had quite a sustainable dividend for quite some time. So of kind of the three positions I'm talking about today, I'd say this is probably the most defensive of the positions out there. They seem to be doing quite well, regardless of sort of the macro environment currently that we're seeing. And then I guess the last piece that I wanted to sort of talk a little bit about today was with really on if I were to say Roche has been a very consistent play, and it's one that we have been very, very happy to be a part of, and we've jumped in and out of it a couple times over the past year, but it's one that we're currently happy to have and is increasing our international exposure in Europe as well.
So it's been consistent, but you're still jumping in and out?
It's consistent in its dividend and sort of its defensive position, but from our standpoint, it has to have positive price momentum for us to participate in it. So this is where we've jumped back into it again recently.
And what are some of the things bringing it to the table to you, or bringing your attention to it that it looks like it's going to trend up?
It's primarily risk-adjusted return. So that's really kind of our main focus, and our primary data point that we're looking at is it behaving well right now or not. It's fairly binary in that sense. So we don't take a lot of opinions on the stock overall, but it has had a very strong fundamental backing in it over the last little bit, and so that has frankly been supported by the current price movement.
That was Shiraz Ahmed, CEO of Sartorial Wealth. Coming up, could high energy prices break the momentum of tech stocks? That's next. Have you ever wondered how retailers decide the prices they're going to charge and how often those prices fluctuate? CTV's Pat Foran takes a look.
Whether you're looking for a coffee pot or big-ticket purchases like appliances and mattresses, prices will fluctuate. There's been a lot of discussion about dynamic pricing, changing prices based on demand, but retail analyst Bruce Winder says that's not new.
If you get your weekly flyers, you'll see prices go down for a week and then they'll go back up. And then maybe 6 weeks later, they go down again.
Consumer Reports just tracked 16 popular products to give shoppers a clear picture of how prices rise, fall, and fluctuate. Take this Shark vacuum.
1 week it was like $119, and at its peak it was close to $200. So it would swing by $40 or $50 a week. We're seeing it with baby products, a lot of clothing and footwear.
While some retailers are experimenting with surveillance pricing in the U.S., where consumers are charged different prices based on their personal data, Winder feels it won't be prevalent in Canada.
Charging consumers different prices because they're different consumers is taboo. The reputational damage to the company would far eclipse any margin gain.
If you're trying to save money on electronics, consider buying an older model. TVs, phones, and laptops that are a year or two old can cost hundreds less. And consider refurbished products.
They take it, they clean it up, they replace parts, and you get it with a new 1-year warranty. I mean, there's no better deal in my mind than getting a refurbished item.
Certain items also go on sale at specific times of the year. AI can help research that. If you can hold off on a purchase, you could save money.
And you might find out that this is one of the items that is really used aggressively on Black Friday or Cyber Monday or Boxing Day, right? And if you can, you might wait.
That was CTV's Pat Foran reporting. Markets are back near record highs this morning on optimism that the U.S. and Iran are approaching a peace deal. And we sat down with Jay Bala, CEO of Senior Portfolio Manager at AIP Asset Management, who says that while markets are treating geopolitics as background noise, energy is one variable that could break the AI narrative.
key ingredients for compute and for the AI rally really is just energy. It's whoever has cheaper energy and can build out more compute is going to win the AI rally. And so, if you have oil prices at 100 or going higher, it makes it more and more expensive to develop all of that AI infrastructure. So, I think that's going to be key.
We know tech companies, they've been posting strong earnings so far, but a lot of the results that we're seeing now are from before the war in the Middle East really began. So what are you expecting to see in the next quarter with that in mind?
I think, you might see some prices increase, but I don't think a short-term disruption in energy is going to cause that problem. I think if you have a longer-term issue where, the issues with Iran and the Strait of Hormuz go on for, quarter after quarter, year after year, I think you're going to see some significant problems. But I don't think a short-term problem is going to really slow down anything at this point.
Right, but it is kind of a situation where, like, as you say, if this war was to be prolonged, the longer it goes on, the longer we'd see the after effects, right? The trickle-down effect.
We would. The one thing to keep in mind, though, is, keep in mind that if you look at, Canada and U.S. as sort of one continent, we are energy independent. So, it might not be so great for the rest of the world, but you could effectively create Fortress North America where you have, one energy powerhouse, and we would have sufficient energy to effectively power our AI, and we would have sufficient energy to power our economies. It may not be so great for the rest of the world, but I think we would do pretty good. So there's also that angle that we should take a look at as well.
Do you think anyone is taking a look at that? Because that's a good point that you make, but do you think there's conversations about that being had? Are we really stepping up to the plate in that sense?
I think so. Ultimately, I don't know if it's front and center in terms of news, but I'm sure there's plenty of people who see the realities, right? America is the largest oil producer in the world. I think Canada's number 4, but we are their single largest supply of oil. If Canada stopped supplying everybody else and only focused on our continent, we would do great. I think there's probably a lot of discussions going on behind the scenes where people talk about, building out infrastructure and building out pipelines and making sure that we're at least fortified because, AI is a very important strategic technology for us on a go-forward basis. This will redefine, I guess, human history over the next 100 years. And so, look, we need to get this right.
Okay, so let's talk about some of these big companies because we've got some IPOs coming up, some potential IPOs for SpaceX, OpenAI, Anthropic. You say the Mag 7 could eventually turn into the Mag 10 instead, tell us more about that theory and why you think that's the case.
Yeah, if you look at the sheer size of these companies, they are already, call them top 25 companies in the world. But what's most important is they are the fastest growing companies in the world, right? So, SpaceX, they're talking about coming out at a valuation of $1.75 to $2 trillion in value in market cap. That would make them a top 10 stock in the world.
How would that change the market going forward if there was more Mag 7s, if they became a Mag 10, for example?
Yeah, no, look, I think we just adapt to that new world, but I think this is the new realities, right? You're going to have this huge bifurcation between these monster-sized AI companies that are part of this new revolution, and you're going to have everybody else in a way. The way we always compare it to, AI to history is, it's kind of like building the first new factory, right? Like we're creating the industrial revolution, but more oriented towards services. So, you can imagine 200 years ago or 100 years ago, Ford coming out with a assembly line suddenly changes the entire dynamic in how that industry operates, right?
The S&P 500, we're tracking this week as well, considering changing profitability and inclusion rules for mega cap IPOs. What do you think about this potential decision coming and whether it's a good idea?
Yeah, no, look, I think it's a great idea. I think at the end of the day, we also just need to understand that the world that simply is, meaning that these indexes have decided to compete for the likes of OpenAI, Anthropic, and SpaceX. And so they're effectively changing the rules to make sure that they can compete for these companies because they don't want to get left out. And so, I think that also changes that power dynamic, and it changes the way that people should think about trading these stocks. So the one way we always look at it is that there's an effective index arbitrage here, right? Those that can get in, companies like SpaceX, OpenAI, and Anthropic, before the index inclusion are going to stand to benefit. So there's a couple of ways to do that. You can either buy it in the pre-IPO world if you're accredited and you have access to it. You can buy it on the first few days of trading. And then, once it hits that index, what you'll see is a huge amount of passive money that rolls into that. Mm-hmm. So as an example, the NASDAQ 100 has $5 trillion worth of ETF money that tracks it on a passive basis. And that $5 trillion can only buy those 100 companies. And so if you think about, just basic metrics, if SpaceX goes public and it's 1% of the index, that means, as soon as they get added to the index 15 days later, there's $5 billion worth of forced buying power or passive money that has to buy that stock, right? And so you can imagine what happens to that stock after 15 days.
That was Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Market Call is coming up next. Today on the show, we have Kim Bolton. He's the President and Portfolio Manager at Black Swan Dexteritas, and he'll be taking your questions on technology stocks. And also join us today at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to knowyouroptions@bnnbloomberg.ca. And we're going to take a look at how markets on Bay Street and Wall Street are trading before we wrap up here. The TSX seeing some gains today, still up 1.2%. It was above 34,000 points. Now it's dropped slightly below that. If we take a look at where some of the biggest gains and losses are today on the TSX, the materials sector seems to be doing quite well. We're seeing a rally in gold and silver prices today, particularly because of the news coming out of Iran, where there could be a potential end to the war soon, potentially. IM Gold is up almost 15%. Same with Nova Gold, and Pan American Silver is up just under 12%. If we look at some of the biggest laggers, though, it is the energy stocks. Vermilion is down 11%. Suncor also down almost 7%. And Cenovus down, of course, on news of the potential for the end of the war in Iran. Thanks for watching Morning Markets. We will see you tomorrow. Market Call is next.